Hi everybody, welcome back to another video. In this video, we'll go through SIA and IREIT Global's REIT earnings results. For those who are new here, I'm Ben, who likes to analyze on different companies' results. If you like my content after watching, you can leave a comment on what companies you would like me to work on next. Thank you, and let's get started. For SIA, they can be considered a growth or a potential dividend play. Why? It's because it gives decent dividend, but it's also in the airline industry, which can have potential for growth if managed well. When it comes to investing in companies, there are different factors that needs to be accounted for. The two most important pointers to check is, first, is there constant increase in the profit? If it's not, it means that the growth of their expense is faster than the growth of revenue. This is bad as this shows the inefficiency in the company's management in their finances. Second, how are the companies spending their income? Do they give dividends, do share buybacks, or invest back into the company for growth? So these are actually two main things that you have to consider when it comes to investing in any company. Now let us proceed to SIA's results. For those who are new to SIA, they have essentially three groups. The first one is definitely Singapore Airlines themselves, followed by the budget airline of Scoot, and lastly is their engineering company. The main focus is Singapore Airline, which contributes bulk of its revenue. Let's look at this quick table of operating profit, where year over year for financial year it's up 1.3%. But when we compare it to the second half, it came in worse at 13.1%. So this might indicate that there might be a possibility of a slowdown in the travel demand post-COVID. So if you see this chart, record profit was hit during the Q1 of financial year 23-24. I'm sure when you're traveling, you would have felt the pinch on the expensive air tickets. During this period, even as air tickets prices will rise, people still do not mind paying for them, thus resulting in the record profit for SIA. The risk is that as the demand for travelling normalizes, SIA profit might drop, which we are seeing the effect now. For airlines, having enough capacity to generate income is definitely very important. That's why they have personal capacity and cargo capacity. The higher it is, the better as they have more spaces to generate profit. If you look at their finances, on the year-over-year comparison, it looks decent with revenue going up 7% at 1.237 billion, while expenses went up slightly lower at 1.202 billion. This is why it resulted in an increase in operating profit of 1.3%. However, the problem is with the second half results. Revenue increased by 492 million, but the expenses increased by 776 million. Thus, this caused their operating profit to start dropping by 19.5%. As an investor, this is something to be cautious about. As companies experience drop in profit, dividends might be expected to fluctuate or drop. Now, the issue with airline companies is that their expenses can be very high at times due to different reasons. First, depreciation of assets and maintenance fees costs on their planes. Second is the fuel costs. And third is the competition from different airlines. This is why for airline companies, their expenses from all these factors will result in lower profits. If we look at this slide, they have to actively ensure that maintenance and modifications of their plane is done. This will definitely cost a lot of money, which can be seen here in slide 23. The expected expenditure is expected to increase significantly from the expected 3 billion expenses in the upcoming quarter to 4.5 billion in the following year. So my main concern is that with this huge expected increase in expenditure, will the revenue be able to increase as much to offset this increase in the expenses? Else, if the revenue growth is slower, the profit will be expected to drop. Another risk to consider is that what if there's a slight chance that the Boeing planes that SIA is holding is affected by any unfortunate events that might happen? So these are things that needs to be accounted for when it comes to investing in SIA. Fuel cost is another main problem for all airlines. If you see this slide, it takes up bulk of the expenses in SIA. Therefore, similar to REITs hedging their loans, airline companies also hedge their fuel prices. However, it's important that they balance the hedging to ensure that they do not hedge too much at a certain oil price, so that in the event when the oil price drop, they can benefit from the lower fuel prices. The third pointer is the competition from different airlines. For SIA, it might not look like a big issue as long as people do not mind paying higher price for SIA flights. Fortunately, based on this chart, they seem to be doing well in leading the competitions. On the bright side, the company is making the right move by using the profits they earn from this post-pandemic travel hype to fully redeem the mandatory convertible bonds issued during the tough times of COVID. These bonds are similar to how REITs issue perpetual securities instead of taking on loans. That's why you see that for SIA, their liabilities did not change even though redemptions were made. But this helps to boost their adjusted net asset value, which equates to higher return of equity for investors as well. At the current share price, the dividend yield is about 6.8% to 7%, with semi-annual dividends paid on August and December. With the possible risks that I've listed, I feel that it might be the reason why the share price is not going up as much even though they have a very good result. That's why the dividend is priced at a very attractive level. So there's a chance that as the travel demand normalizes, SIA revenue and profit will be expected to decrease and thus possibly giving lower dividends. Of course, if the rebound in tourism is able to support SIA's earnings, investors who buy at this price will definitely be heavily rewarded. I hope that this analysis has been informative so far. Please support the channel by hitting the like, subscribe and comment on what you feel about the earnings as well. Thank you, and let's continue with the video. Next, let's go on to a purely overseas REIT listed in Singapore, and that is IREIT Global. IREIT Global is a REIT purely focused on Europe in both retail and offices, with 9 offices in Germany and Spain, while 44 retail properties in France. If we look at the financial year 23 report, revenue is up 15.7% while property expenses was up 19.4%. This is common for all REITs and it was due to an additional retail acquisition in France. Net property income came in higher at 14.6% because of higher growth in revenue, but the distributable income still dropped by 13.5% and 19.2% year over year. This is bad, and let's investigate the reason why. In this slide, they have mentioned that the fees paid by tenants for the expiration of the Berlin campus was kept for the improvement of the property, while rent-free was given to tenant as well. Moreover, if we go to their financial statements, finance costs increased by 21% year over year, and this was stated in Note 8 due to loans taken for the additional purchase of the properties in France. So because of all these factors, this resulted in more expenses required to be minus from the property income, therefore resulted in a lower distributable income. So this is one quick way to look into why there's a drop in distributable income, because some REITs do not put much information in their financial slides. There was a preferential offering being conducted during the purchase of the additional properties, which also led to the dilution of the units and thus expected lower DPU. Debt-wise, IREIT Global is well positioned with their leverage ratio at 37.9%, while the cost of debt is only at 1.9%. With the low cost of debt, this is why their interest coverage ratio is at a high of 7.0 times. My main concern will be the debts that will expire in January of 2026. Although it's quite long down the road, it's expected that interest rate cuts do not come as fast as expected. This means that interest rate will be higher for longer, with rates expected to be at 3.0%. This will definitely increase IREIT Global's cost of debt when they have to refinance this huge amount of loan. So this is one factor that you have to take note if you are interested in IREIT Global. Tenant-wise, the risk is that they have a huge tenant expiring in December of 2024. It accounts for about 24% of their gross total income. Based on the news, it was expected that the tenants will not renew because the management will be refurbishing Berlin campus to be a more attractive property. Once this tenant expires, they are expected to refurbish this asset into multi-purpose assets. It looks nice, but the concern will be how long it takes to finish, because during this period of time, IREIT Global will be losing their biggest asset temporarily. This is a common risk for smaller REITs. Unlike big REITs which have a lot of properties, they can do enhancement easily without their total income being affected. For IREIT Global, they will be doing enhancement on their biggest asset of 44.6%, which directly will affect around 25% of their total income. So as an investor, it's expected that the dividend will drop during this period of asset enhancement. Another possible risk that I see is that leverage ratio might go up when the property valuation drops during this period of enhancement. Therefore, with the expected drop in dividends, this might be the reason why the share price has dropped to a lows of 31 cents. This is even lower than the COVID crash of 40 cents. At this share price, the trailing dividend is at an attractive level of 8.63%. But do take note that the old dividends does not equate to the upcoming dividends, and I'm sure that the dividends will continue to drop in this situation. In this high interest rate environment, it is definitely important to be cautious when it comes to investing in smaller REITs, as they will definitely suffer more. Next, someone asked with regards to my opinion on the Europe retail and office environment. In my opinion, retail and office is not as attractive overseas as compared to Singapore in general, because overseas they are not as dense as Singapore in terms of population. Therefore, it's harder for people to visit the malls or offices in overseas environment as compared to Singapore. One of the main measures I feel that in order to measure the performance of the overseas retail is by looking at their shopper traffics. Shopper traffics essentially determine how many people are actually visiting the mall. More shopper traffics will definitely attract more tenants and therefore more income for the REIT. However, overseas offices is a big problem with more companies implementing work from home and cutting office spaces. Banks are also more conservative in loaning money to commercial real estates, which might be another risk, as this means that REITs will have to take on more expensive loans due to the risk management. So to me, I would preferably invest in data centers or logistic REITs currently, as they are in higher demands. Thank you so much for watching. I hope that this video is very informative and helps when it comes to choosing the right investment options. Please support the channel by hitting the like, subscribe, and comment on what other companies that you would like me to analyze on next. You can also watch my recent analysis on some good REITs and guides on how to start analyzing in REITs or companies. Thank you, and I'll see you in the next video.